when we're taking a look at the portfolio tool on the rollout opportunities, we have our return and we're analyzing, does this match my goals? If I'm going weekly, is this at least 1% weekly or 0.8%? This one's close. Now the 55.50 gives me 5%. That is a 1.3% increase in return, even though I'm rolling for a debit, right? I'm paying $5.35 off of the $1.30 I collected, but I'm only getting 68 cents. But if assigned at 55.50, that would go up to 5%, another 1.3% gain for a 5-day, 7-day trade. That matches. Now, I have to ask myself, do I think AMAT is strong enough to go to this point above 55.50 next Friday where I'd realize that 5% return? If it's not, no problem. Not doing either of those three. We'll scroll down now and look at the rest. Okay, so what did we do? We bought stock at $49.50, sold the February 50 call for $1.30. We could be assigned right now and be at 3.7% return. Again, we're assuming we adjusted this before the close. So we can go 14 days out. But now, I'm not looking for a 1.1% gain over 3.7 or 1%. It's got to be plus 2 because I'm extending it to 14 days. Only these two come close. Again, the 54.50 and the 55. Oh, and there's the 55 as well. And the 56. So the 56 would take our return up to 6.5%, gain of 2.8. 14 days out, 56 call. But 14 days from now, do I think AMAT's going to continue above 56, or would I rather be safer, go 14 days out here and gain 1.2% to 4.9? Well, I wouldn't, because that doesn't match my goals. Okay, so when you set up your structure to identify your trades, you set up your structure because you wanted to look for X amount of return in a 1-week, 2-week, or 3-week position. Your roll should match that exactly. If it doesn't match your trading goals for what you originally set up with your covered call positions, then it's not worth it. Okay? Why roll to go against yourself just for the sake of rolling? Maybe let it get assigned now that it's moved that high and move on. Of course, if you wanted to roll for a credit, we could scroll down further. And we have to go out, looks like the first one is right there. I'll highlight it. The March 16th, as I mentioned, 1 month out, at the money. We paid $130, remember? We collected, $130 in premium. We have to pay $535 to buy it back. If I sold the March 16th, 28 days out at $545, okay? And then we take in another $545. So now I've rolled for a credit, so I'm still at a 140 credit with the potential of being assigned at 50. But that only gives me a 4% return. That's rolling for a credit, but this is not the return I want, is it? No. Going an additional 30 days out, this would have to be 6.7%, 3% higher than what I have right now minimum. Okay? I have to go up to the 55 call, which is still rolling for a debit, but I'm matching my goals for another 28 days of trading. That I feel is more important than trying to roll for a credit or roll for a debit, is making sure the new return when you roll up or down matches your specific criteria. Okay, so that's what I look for, and that's how I use the Power Options tools, the position analysis view again. When I've got a covered call, again, we bought at $49.50 and sold the February 50 today, $1.30 premium, and the stock's at 55. What do I look at when I roll? Does the new return match my target, my trading goals? And again, from here I'd go to position actions and position analysis, analyze that, and see if the weekly matches my goals. If I can get another 1%, 0.8% by rolling out for the next 7 days, 2% higher than what I could get right now rolling out for 14 days. And if I'm trading monthly as my goals is 3%, rolling to the March 16th series has to give me 6.7% because I'm currently making 3.7 if I get assigned right now. And the reverse, of course, if it drops, well, you're trying to be protected on those positions. You're trying to naturally hedge the loss, but when you're rolling down, you have to make sure that if it pops back up and you get assigned, that you're still going to be in a good place, okay? That you're not going to get assigned for lost, okay? All right. Sam just saw something that wrote something, and I'm scrolling through the list here down, and Sam just wrote something there as well. Earlier we looked at the chain, the historical chain, to go back in time when we pulled up our February call that we bought, the 50 call. We went to the chain, we went back a few days. Darnell had asked, is backtesting available? No. Well, backtesting is available, but it's not available in the standard subscription. We'll talk about that at the end of the webinar, but there's different levels of subscription. Okay, I've got about 35 questions, believe it or not, all from the similar people, all about from 5 or 6 people with different comments. So I'm trying to organize the questions. I wish they gave me a way to do that, but I'm trying to organize it so they're all in one. So I have 3 investors here who ask continuing questions about a position, but it's broken up by questions from 3 other questions that came in at the same time. So I'm just going through those. All right. Arvind has joined us. That is the next question that came in line. And Arvind's question is, well, first off, he says, how is everyone and how am I? I'm great, Arvind. Thank you for asking. I hope you're doing well. I said, I'd like to know UVXY. What is the future? I can't predict the future for any stock or any option. UVXY is the ProShares Ultra VIX Short ETF. Okay, so we all know that VIX had a large spike last week. And of course, the Ultra VIX Short did as well. And then just as we'd expect, like as in the VIX, it came back to normal. Okay. Now, the reason why Arvind is asking that, he said, I made an incorrect strategy and lost around 15K, but I rolled from the 35 call to the 40 call and an uncovered sale. Okay, so you went short UVXY. I'm not a fan of doing that. I may do a debit spread on the bearish side or a credit spread, but I will rarely just do a naked sale on any VIX, VXX, UVXY, or anything like that. And the VIX we saw was similar numbers. It spiked from $10 up to almost 40, 38.40, I believe. And then it's come back down about the same levels to about 18, okay? All right, so what you did is you sold a naked call at 35, I believe you're saying, or a naked option at 35 call, and you rolled it to the 40, okay, and it's going down. So do I think right now that the VIX is going to jump back up into that range, up to the $40 range? Well, no, not without a catalyst, okay? So if you're up in this level here, you've rolled to the short call because the VIX started to move up here, or UVXY, my apologies, started to move up, and then you rolled your naked call, which is this kind of profit and loss chart, infinite risk to the upside. I can't predict the future, but I'm going to say without another catalyst, I don't expect UVXY or the VIX to spike back up to that $30 or $40 range. That's not to say it can't happen. Anything can happen over the weekend. We are in a 3-day weekend here, so it's hard to judge. But do I think right now, what have we seen with that, or just with the VIX itself? And we did an example of that last week on the market hedge from January 29th to then. It looks similar, very similar chart. But yeah, it almost peaked out at 50, but it pulled back enough there. It went up, but then it came down and it closed at about 30. That was a very volatile day, but then it crept back up. Okay, well, without another catalyst that we saw, it almost seems like it's priced in now, but without another catalyst, I can't see it going back up, the VIX going back up to the 40 or 50 range, or UVXY. Could it? Absolutely. But that's all going to be based on something you can't predict in the market. You can't really take this as a normal technical trend. I know Sam has more insight on the UVXY than I do, and the VIX probably too. I traded a little bit here and there. But in my opinion, you can't trade this like a normal stock. If I'm looking at a normal stock, I'd say, okay, hey, this gapped up, but then it couldn't hold it. It fell back down. It's dropping below its 20-day moving average. You have MACD crossing. I'm expecting this to continue down because of the technicals. The VIX doesn't work that way. Any outside market catalyst could cause it to shoot up, or any positive news. We could see this back down to 12 or 15 on Tuesday. My apologies. Okay, so it's hard to teach that as real stock. I can't predict the future. I think it's going to continue, hopefully, this drop down slowly, and it'll go back maybe to that 12 or 15 range, but there might be a hiccup here. It might go up to 20, 25. Bad news here. A big stock might have bad earnings in the next week, and that might cause a little bit of fear and you might see a little spike up to 22 or 23 and then calmly coming down. Then it'll spike up to 18, 19 and calmly coming down. As long as things remain stable, as long as no other surprises come out, no big measures of fear, no big measures of short selling, things of that nature, it's highly likely that we'll see the VIX continue to pull back gradually. I mean, it went up 33 cents today, but it was down near 18, I think, at one point. And so that's the idea. Now, Sam does say, against what I just said, and he's not saying it against me, he says follow the trend, okay? Don't predict UVXY, just follow the trend. That's how he trades it. That's how he applies it. Sam does say he thinks it's going lower, buy puts. Okay, I'm throwing that out there. That's what Sam's comments are because he does UVXY in the VIX. Remember last week when we were talking, I said that I had that really good run. It wasn't a good run. It was a good time for a market hedge when on the 29th, when I saw our market sentiment tool flip over, I bought those calls on the VIX that ended up being a large profit which hedged and gave me a profit over the losses I took on my bull put spreads last week with that huge correction and fear of VIX adjustment, okay? And then I said, well, when was that? It was last week. I'm sorry. Let's go back. To show you again, Daryl, when we go back here, when I'm on my trial, I can go back 3 months on the history or the back testing. But on the standard subscription, let's say the end of day data, there is no historical tools. On the 20-minute delayed data, you can upgrade to an additional $40 per month to have access to the historical back testing tools and screening tools and option chain going back to April of 2006, but it's not included in the regular 20-minute delay or end of day or real-time subscription. There are other levels. Okay, but in any case, we were back last week on the 9th, and the VIX was at 29.06. It was around 32 all day, and I agree with Sam. You know, I even said that during the webinar last week. After I had these large profit in those 14, I think it was the 14 strike calls I bought for February 14th. Okay, I ended up closing up that last call that I had. Yes, I did close on Tuesday, actually. Excuse me. But when the VIX was at 11-ish, I bought the 14 calls for February 14th expiration. Used that to hedge my portfolio, closed them out at different intervals. Now, on Friday, I was saying, well, someone said, well, why aren't you buying the puts now if you think it's going to stabilize? Look at the prices. On January 29th, I bought those February 14 strike calls for, I think it was 45 or 55 cents, 2 strikes out of the money. Because of the increase in volatility on the volatility index, 2 strikes, 3 strikes out of the money, you're looking at 225, 245. And that's for this expiration. You go out further, there's 610, 540 to 810. You know, wide bid-ask spreads. So these are really expensive. So let's take a shot in the dark. Let's say Friday, February 9th, with VIX at 29.06. Let's go good. Let's make it 4 points in the money. What if I had bought a put? Jeez, look at that bid-ask, 390 to 660. All right, so we're talking $2.70 difference, $1.35 midpoint. So I would have probably paid close to about $4.25 to $4.30 for the February 21st, right? Yeah, February 21st, 25 puts. Okay, let's go where we are today. Let's click on current up here at the top. February 21st, 25 puts, bid of 460, ask of 630. All right, so again, that's another $1.70, 85 cents. So I might get $5.45 back, roughly. Okay, so I paid about $4.30. I get $5.45 back. I made $1.10 on that position. And the VIX dropped. Remember, it was at 29. It dropped 10 points. I've only gained $1. How is that possible? Because VIX options don't perform the same way as others. It's not about intrinsic value per se. Okay, it's about that future projection of where the market's going. Okay, but look now that the VIX is settled, if I went in today and bought 2 strikes out of the money, I'm paying 50 cents instead of 5.40. Okay, so the puts were really expensive last week. That's why I didn't buy any, even though I thought the VIX was going to settle down, as Sam did. And Sam traded it that way. I didn't buy them because I thought they're too expensive. Now they've come down and they're a little bit less expensive to buy the puts here if we think it's going to go down. I'm not saying it's going to go to 18 by February 21st. I'm probably going out to the 27th. That makes more sense, $62. But it's not $4. It's not $5.45. It's not $4.25. The volatility on the volatility index is settled, so the prices are more in line now of what you might want to look at. All right? Okay. Sam does trade UVXY and SPY at the same time. He says the option premiums are overpriced on UVXY as well as what I just pointed out on the VIX, but they've settled a little bit both on the VIX and the UVXY. All right, so let's see here. Let me go back. Okay, so this is another position here. We've got, still several more questions coming in, but another discussion here on OHRP. Okay, this is one I don't know if I can answer. That's going on with this OHRP, which we've talked about before, I believe, Arvind, your position on OHRP. Highly volatile position. Let's just go ahead and take a look at the chain again, the current chain. Oh, that's right. I'm sorry. This is the question I can't answer for you. I remember it now. OHRP actually is dipped down below. It doesn't offer any options anymore. And this is that 30-cent stock, 35 cent, 13 cents, 26 cents. Okay, so it was up to 2 here, had this breakdown here, and you say, I try to sell that, I don't get a good premium, but when I wanted to close the position, the premium is $5 per stock. How? Again, that's a question for your broker. I'm not really sure because I don't track this. We did this a couple weeks ago. We looked at the 2-day or the 5-day, and we looked at a 5-minute chart for it. And there's a couple. You see some large spikes here between 28 cents and 27. That doesn't sound like a lot, but it is when you're trying to get filled at a premium, and it keeps just falling against you and falling against you. So I don't really have the good knowledge on this one. Again, as I mentioned a few weeks ago, Arvind, I do apologize for that. This is something you may want to talk to your broker about. Or another investor there to see what their thoughts are as well. Okay, all right. Okay. Now, so your short calls, I'm sorry, going back, you did have a follow-up question there that I missed, UVXY. If you're at the, if you're up at the, oh, good grief. I almost find that harder to read when I do that. I forget to switch back. Just like a covered call or a naked call, your 30 calls should expire worthless. Your 30 or your 40 straight calls should expire worthless. It's down to 16. Okay, those are just going to expire. And if you have a short put, you can't be assigned? No, you can. If this is an ETF you can purchase, and I believe that's why Sam trades it, so to help him with the hedges. If it was a short put, you did. In other words, if it was a short put here on UVXY that you sold at 30 or 45, you're going to get put shares of UVXY at that price, 35 or 40, if you haven't closed it yet. So if it's a short put you were rolling, then you maybe put shares of stock at that higher price, shares of this ETF at that higher price. You may look to manage that. You're going to have to manage that by a covered call, or take a look at the stock repair. I doubt we'd find anything, but let's say that I got assigned at 35 on UVXY at 100 shares because of the enriched premium. Nope. Okay. No credit or debit repairs can be found. So in this case, what I might do, if I got put at 35, I might average down by another 100 shares at 16. Okay. Knock my cost basis down to what, $25.50, $26 per share. Let's call it $26, but I now have 200 shares. Okay, if you end up getting put the stock, your broker may just close it for you, but most likely you'll put the stock. Now there's a repair out to April if you can lower your cost basis down to 26. So discussing what we did last week with the managing your broken position webinar and so forth, you'll be able to take a look at that as well. So if you get put the stock, you might want to cost down, average cost down there, and help you get a lower price on the position. Then check out that stock repair, the 2-to-1 ratio, to help you get back to break even. But again, difficult to say, because if even if you lower your cost basis on VIX or UVXY to 26 from where you were at 35 or so, as Sam says, follow the trend. If it looks like it's going to continue down as it's been easing off, it's going to need another catalyst to spike back to that range. And the repair is based on the ETF going, or the stock or the ETF going back to those prices. So it may not happen as you want. Okay. All right. Sam was just made a comment. He said Strategy and SPY bought the 280 and sold calls at 275 last week. At the time, the SPY was at 284. You see here we ended up at 2732. Okay, below the 275. It was expiring Friday, but got out of the put at 255 and then bought the calls at 260. Okay, so you bought 260 calls now, expecting a gain to go back up with that other hedge. Okay. Okay, so questions that come in from Daryl. I'm sorry, I don't know if he's still here. He might have bounced out and then come back in. He said he sent an email, and I had mentioned earlier that I didn't see his email. I can pull it up probably now, but he said, is everything the risk graph tables, etc., printable, I believe is what he was asking. He wanted to know if all of the tables and all of the information on Power Options is printable. Well, in a sense, yes and no. Okay, so if I go into a search, I'm just going to go into the naked put search for the time being. We don't have a direct export to Excel from this feature, but that's why we offer this printer-friendly version up here. Okay, so what I can do is, as I'm looking at the search results, Daryl, I can click on printer-friendly results. It gives me a nice table without those graphics. I can print this out in a form, or it's now much easier without the different images and so forth to copy and paste and put it to Excel if you wanted to make adjustments or sorting adjustments in an Excel format. That's the best way to do it, is use the printer-friendly version. On the search by symbol. It's not there on the option chain. But when you're looking at the profit and loss chart, for example, there's not a direct print button here, but oftentimes or not, you've seen me do these presentations in on slides and so forth with this image. Typically all I do is I just take a screenshot of the profit and loss chart and then put it into Paint, put it into my presentation. You can also go to just print chart here, you know, sort of right click on it. You can print the chart, or you can go to full screen. I didn't like that, the way I was doing it. But you can go to full screen so you can see a bigger chart there on this position as well. And you might be able to print that out with a screenshot also. Okay, so that's some of the other things. Again, the option chain isn't what we looked at earlier in the portfolio. Real quick question. You can request to export your portfolio at any time to Excel and print it from there. You can also select to have your portfolios emailed to you. Simple checkbox. I'm sorry, there it is, right up top. Email portfolio daily. So that just comes to your email, and then you can print it out from your email. It's not the same format here, but it gives you the general information. We typically use that as a backup if you want to. But I get my portfolios, my real ones, not the webinar account, but I get my real portfolios emailed to me daily, which sounds silly because I'm always on the site and I don't get any time that much anymore to check things after hours, unless they're really late after hours. That's another story. But in this case, yeah, you can have the emailed to you daily, or you can export it at any time. And the position analysis screens that we looked at earlier, and this one's for the long call, I usually just print this page out directly. You know, I just use the browser to print it. It's not like a printer-friendly format or a printer-friendly version, Daryl. I can just do it that way, okay? All right, so I still have a fair amount of questions here, folks. And have to stay with me. Oh, and a follow-up question from Daryl again towards the end. He says, will the program optimize suggest the best option spread to turn this underwater call around or mitigate some of the potential loss by rolling? Yeah, we walked through that. The position analysis tool, you see here, we're looking at the long call now that we had a profit on. We already walked through the position analysis on the covered call and the rollout opportunity. It's not optimizing it, but if you know what you're looking for, you know how to match your goals, that you'll be able to quickly pick the best one for you. This one here shows me rolling to the higher strikes rollout opportunity that I could do for that long call. And this one here, you know, I could roll up to the, I'm sorry, look at there. I could roll up to the March 9th 55 call now to have a negative risk on this long call. So I'd still lock in a profit of $1.58 when we have the 370 profit now, but if it keeps going up, I have nothing left in there. So anytime you're tracking with the standard positions in the portfolio, you'll be able to do that. Rajiv, I apologize. I've got one part of your question coming up right now. Is this it? This is it. Your second question that you sent in just got lost. I was trying to delete Daryl's last question, and it deleted both yours and his. I don't know why it did that. So I'm going to take your first question here on FCX. All right, we're going to take a look at that. And then I'll see what your follow-up question was, the second part of that question that you asked. So let's go back to the beginning here. Let's take a look at your question. You have a married put position on FCX, a February 18 expiration of an 18 strike. You sold stock around 60 days ago, around the 20s. Okay, so what did we do here? This is going to be a little bit complicated to follow this, okay? So at one point, and I don't know your cost basis, but I'm going to go ahead and say you maybe bought 100 shares of FCX at around $16.50, let's call it maybe even $17. I don't have the number of what your original purchase price was, okay? It might have been less than that. Yeah, I'm going to call it $16.50. And then at some point in there, you bought this expirations. You just say February 18th, so I'm assuming it's this expiration. 20 strike put. And you probably paid something along the lines of maybe $210 for it or $220. Okay. No, you would have paid, unless you legged into it, you would have actually paid, I meant to say, about $420 on the position. All right, so 3.4%, this looks about right. Maybe something along this lines. Now, you sold the stock 60 days back when it was in the 20s, and I'm assuming a price here. So what does that leave us with? We close this out. Let's say we got a profit of only $3. Well, I can't calculate that here, but what I can is reduce that by $3. So my cost basis instead of $420 on the put would have been $120. So you're holding a long put. And it's the 18 strike. Oh, I'm sorry, it's the 18 strike. Let's just use this fake math I'm using here to put in the 18 put at a cost of $120. Yeah, this is, without all the exact numbers here, it's very hard to do. But okay, let's say that we took some profit on the stock, it reduced our cost, we're holding a put at $120. Excuse me. And then after 1 week's assessment. All right, you also sold the 20 strike put to get back in the price was between the 20s. Now FCX closed between this. Okay, so yeah, here's what's going to happen. If they both were for February expiration, and you've kind of got a bull put credit spread, and the stock's at 1873, so let's say it's at 20, this is only 95 cents, something strange number. So you're in a bull put credit spread. Maybe it was at a profit if it stayed above 20. All right, so what happens now with it between the strikes? If they were both for today's expiration, this expires worthless. It's gone. Your February 18 put that you bought is gone. It expires. This is in the money. You're going to be forced to buy X amount of shares of stock at $20. You're back in the stock position at $20. If you want to continue to trade it going forward, on Monday you'll have to look to buy June, July, sometime in that time frame, maybe 21, 22 strike put, maybe even a 20 strike put to recreate the married put position. But then, looking at your cost basis for the stock was 20 minus your naked put premium, minus any profit you had from closing the stock when it went up to 20, and then, of course, adding back in a loss you took on that initial 18 put. That would be your new cost basis for the stock, and then you'd want to take that and analyze it as a new married put position. You're going to be assigned shares of stock at 20. You're going to end up Monday being long 100, 200, 300 shares of stock at that price. Okay, and then what I would do is take my position at this point, because everything already occurred. You know, you're saying, is there another strategy right now? Well, everything's already occurred. There's no rolling or management you can do. We're past expiration. You're going to be put the stock here. This expires. You're now in a long stock position on FCX. Your cost basis, again, is the 20 strike you were put the stock minus the premium for selling the put, whatever it was, minus the profits you took in, and then add back in the loss that you took for whatever you bought this put for here. Okay, that is your new cost basis on the stock. Now, I might use the insurance tool under the married put tab to evaluate what options should I buy to continue this as a married put. But again, married put, you're only considering doing this as a married put if you're still bullish on the stock. If you're no longer bullish on the stock, then you're not going to do this. Okay, you're not going to continue this going forward. You're going to look for a new position, maybe a straddle, maybe a not a straddle, maybe a collar, I meant to say, or something along those lines. Okay, and so forth. Okay. All right. So okay. Oh, the second question Rajiv said was related to the AMAT position that we were showing earlier as well. Okay. And Sam's comment here. Yeah, he says Sam's going a different way. He says if you're neutral to bullish and with things settling down, follow the trend. Again, he kind of mentions you could do the covered call on it if your cost basis is above the price. So in other words, if you get into this and your cost basis is at 1920 or 1930, generate premium with a covered call. But if you're worried about it continuing falling, you'd want to do a collar, which would have a similar risk reward here. Okay, married put position if you're bullish and you have that lower cost basis there to continue it going forward. Okay, so those are the kind of ideas. Remember those three tools that we offer you for this kind of position. On Mana, if the stock is, if your cost basis ends up being higher than where FCX is trading right now, we could use that stock repair that you showed earlier. We have some other ideas in that manage a broken position or manage a broken stock in our free webinars page. If your cost basis ends up being below where the stock is now because of the gains you took when you sold the stock and more, a married put would still look pretty good. Go to married put and go to insurance. So let's say you did take in $3 of profit on FCX. You still lost maybe $1 on the put and your cost basis was 19. So 19, you sold the 20 put, collected $1, so you've got a 19 on the stock put. You got $3 of profit from closing the stock from 17 to 20, and you lost $2, let's say, on the put, so you're back at a price of like 18. All right, so I'll start with all expirations, just hit calculate, and there are some positions short-term that offer a locked-in profit. What I'm going to do is go here and look for at least the position that's the first position that's at least 150 days out. So I might look at August. Okay, so let's go to August here. Doesn't have a June or July series, it looks like, although it does have weeklies. But based on your outlook, how long you want to be in the stock. With stock at 1873, 20 strike put with your position still is a risk of 4.3%. That's for 182 days with a 20 put. You still be able to do management inside of that. But again, it depends on your outlook going forward as well. Sam's going to rub it in our face here. He's giving me some positions. He had major success on Riot. Of course, we saw it dropped about 38%. Sam, I didn't want to talk to you about this, but I missed the straddle on Fossil. I think we talked about it last week. I missed that straddle on Fossil. The stock went from $8 to $17. It's pulled back down to 15, but I'm kicking myself for not doing that. Would have been a 500, 600% return on an earnings straddle for Fossil. But Sam says best 2 weeks there, a couple of positions he did snap. He was doing his UVXYs. He's already up 40% for the year with doing those adjustments. And okay, so we've got another follow-up here in relation to that. Fernando, I'm sorry. Fernando and I had a scheduled session at 4 o'clock. Couldn't make it because of the webinar, so we were going to reschedule. But he says, do you think it could be a good strategy to get into a married put with half the number of stock, creating a synthetic straddle, and waiting for it to complete the married if it goes down? If the stock goes up, you enter the same with a little delay and a little major risk. Yeah, if the market continues what it's been doing for the past 2 weeks. But Fernando, if the market continues what it had done in the past 18 months before what it's done in the past 2 weeks, you'd be scrambling to get into positions at higher cost and it wouldn't work out. So what Sam's saying is that if I was going to get into, Fernando's saying is if I was going to get into a married put right now, I did get into a married put right now. My apologies. Our Fusion subscribers saw this. This was the position I opened today on Interactive Brokers. Price was a little bit different. I think I got the high of the day, of course, because it's me. So as soon as I bought it, it's going to, adjust. But it's a nice married put with a risk of 6.6%. It's sort of a banking and security kind of thing. Not really banking, but a security type of thing, meaning that if the interest rates continue to go up, which they're projected to do, it should help out things like CFG and the different banks and the brokers as well. So I thought this was a decent married put trade. Now, what Fernando is saying is that should I have, instead of buying 100 shares in one put, putting out $7,492, $7,500, Should I have bought 50 shares at this point and only put up 4106? And now if the stock drops, I might be able to buy another 50 shares. It's not going to let me do that. But let's say it drops down to 63, which would put my cost basis at about 65. If I bought another 100 shares and lower my cost basis to 65.50, let's say, am I in a better position now? Well, yeah, that's true. Okay, but I was comfortable with a 6.6% risk. I'm not going to try to mill about. What happens if it goes the other way? All right, so I got in at 67.72 today. The synthetic straddle, sort of, you know, and now the stock moves up to 70 by Tuesday. So I buy another 50 shares, to make this 100 shares of stock. 230 would be 115. So with a new cost basis of 68.90. Okay. Now I'm the other way. I'm at an 8% risk, which is beyond it. I don't try to time it that way. I don't try to micromanage the married puts. I may micromanage my straddles that I'm trading for earnings that are short-term plays, okay? But this is a long-term growth play. I like the stock at the price it's at. I like the put. I mean, I get these questions all the time, Fernando, and you're thinking the right things. But again, I have people who say, well, why would you do this anyway? Instead of doing the married put, which locks me into only a 6% risk, if you're neutral to bullish on the stock, okay, buy your 70 put, but why don't we just sell the March 70 put here and only have, you know, $214 or $345 invested. And if the stock stays below 70, hey, you put the stock at 70, but you keep 375. So now you only have a cost basis of 625. Well, because I got into this position with the expectation that I have the feeling the stock may move up 3 to 6% in the next 30 days. So let's call it 5%, somewhere in between there. What are we looking at? About, you know, $3.35, $3.40, which would put me at $40.70. Wow. $70.70, okay, on my married put. So right here, that's not a bad number. It's a profit roughly of about 198 or so. Let's take a look at what it says exactly, okay? All right, so if the stock was at 70.70 in 30 days, 20 days, be right around here, okay, March 14th. Profit of 135 with this combination. But notice what happens. What if my expectations are exceeded and good news comes out and IBKR goes up to 74, 75, or 76? I'm in a losing zone, right? But in this case, okay, with this cost basis, in this case now with the married put back in play, if my stock goes up to 70.70 on the 14th of March, a little bit beyond, yeah. Sorry about that, folks. Let's go to March 14th again. I'm still at about the same monetary profit. Yes, I have more invested, but I'm still the same monetary profit. And if the stock goes up to 75 or 76, I'm exceeding profit potential, not capping it. There are different ways to make the trade. I've been trading this strategy for 8 years with 40 to 50% of my portfolio, actually more like 9 years. And I don't try to micromanagement. I learned my lesson of why I don't do the naked put first. Why not try to get into the stock with a naked put position first? No, it's because it doesn't match my goals for the position, okay? And why not try to leg into it and go this way and that way and try to buy 50 shares and then add to it and then subtract to it when it goes up and then add more when it comes down? I don't want to spend all day trading like that. This for me is hands off, know my risk up front, know how to manage it when management time is needed, locked in single-digit risk, okay? You had double-digit risk doing your position. If the stock stagnates and stays right where it is, it was almost about a 14% risk. Okay, that's all the way out to September, I understand, but I'm not looking for that at all. Okay, that's not my strategy. And, by the way, what I normally do, and you might disagree with it, is if I was concerned it might go either way, I'd actually buy 2 puts and put more money into the position. This creates the same synthetic straddle with the risk you were looking at, 14.5, 14.7, but I've got 8,200 in. So you're looking to leverage the amount of money you're putting in by buying half first and buying a put. I do it 2 to 1. Okay, if I'm concerned that the market might fall, but I still think this is bullish, I do it 2 to 1. On 314, stock at 70.70. The married put by itself was a monetary profit of 111. The naked put entry, which you weren't asking about, I know, was at 135. Now this one's still actually at a little bit of a loss. It's not as delta, it's more delta opposed, I should say, than your version of buying 50 and buying 1 at these prices, okay? Yeah, so it's still 14.7% risk at 605 on 4105, but again, if we go to 70.70 here, that 3 to 6% movement we think in the first 30 days or so, yeah, this one's still at a loss. So the married put would be at a gain if my target's met. Both straddles would be at a loss, even with the 50 shares, if it matched my expectations. And the calendar put version would actually be highest, but if it kept going up, the calendar put idea of trying to get the premium up front and do it with a naked put is the only one that would be at a loss. Okay, and Sam's comment there, Sam's comment, other comment there was regards to the FCX position. He says, just commenting, he feels bullish, okay? And Rajiv, your follow-up from before was on AMAT. Do we need to wait for assignment or square off around call strike price? Oh, I was showing just the covered call position. If I was in that covered call position, I would have rolled it before today if I wanted to stay in it. Or I would have taken assignment if the rollout opportunities that I saw didn't match my goals for a 7, 14, or 21-day trade, okay? I think that's what you were talking about with the AMAT position for rolling it, okay? Yeah, and Sam agrees with me. He says that you should keep the risk to 7 to 8% or lower. That you shouldn't really go above 10 or 11%, and that's my opinion as well. I don't try to go higher than 7.5% risk on most of those positions. Okay. Let's see, that's Fernando's question there. That's what we were talking about. Mohammed, I believe your question is next. Yes, we are. And we're talking BYD, Boyd Gaming, one that I may have even mentioned during a webinar that I was planning on getting into but didn't open. But that's okay. So let's take a look at Boyd. It was opened on February 1st, and you bought 100 shares at 40.18. 40.12. Fantastic. And following, again, it's a radioactive trade, so we bought the September 42 at 480. I think that looks good. September 42 at 480. All right, so where are we at now? Well, Boyd's down to 37.34. Not too bad. Okay. Oh, this is the one we had talked about. I believe I'd sent you an email about this yesterday. You had 2 positions that you were looking at where you made adjustments, and I put them into your I put them into your portfolio so you could see where they stood right now and what the management techniques were. Okay, I don't know if you received my email or not. I apologize, but if that's, let's see here. Yeah, these are the positions. I'm pretty sure that I sent you the email. So if you didn't see that email, let me know, because I did analyze this. But then what we did, I'm sorry, there's continuation, of course. My apologies. When the stock moved, you sold to close that February 42 put at 8.20. So you made $3.40 on your put transaction. And then you rolled out in time to a lower strike to the 35 put at 4.60. Okay, a little bit different than what I tend to do in those situations, but what it did is it took the risk up to 15.3%. Okay, that's where we were. How do I enter my position in the portfolio and analyze my position? Okay, so I can't add this directly here. Your position should be in your portfolio. If you log into your portfolio and check it out, I have the BYD updated position with your January 35 put in there. I am almost positive. But here's what I'd have to do now. I go back to the portfolio. Since none of these options have expired yet, I would just do the transactions one by one, or just as you would have entered it on the day you opened it. So we'd open our married put on 2/1. Okay, and we had BYD 100 shares, 40.12, and the September 42 put at 480. I just remembered that off the top of my head. I didn't even have to look back. Now I will look back to make sure I have the right numbers, just for analysis. Okay, 42 put at 480, I'm sorry, 40.12, right. So here is your married put that you entered on 2/1. Okay, now, on the 9th, you rolled this leg. So all I have to do is go to position actions, roll leg. It knows what I'm rolling. Change the date to the 9th. Oops. 2/9. Slash. And you sold this for $8.60? Now I have to check to make sure my numbers are correct. Hold on one second. No. $8.20. That's what it was. $8.20. And then the other one, the January 19, 35 was your $4.60. Okay. Submit that. There's Boyd Gaming. Stock is at 37.34. You've got a January 35 put. We talked about the risk being at 15%. Now that you have that into the position, into the portfolio, I simply click Position Actions and then Position Analysis. There's my 15.3% at risk. Liquidation, though, is only 2%. All right. Now, it shows me no rollout opportunities are available. Okay, sometimes that can happen because the criteria that we would use for an adjustment, a 4 or a 1 or a 2, doesn't match what we're looking for, probably because the risk is already so high, but that's okay. All you have to do now is go to what if calculations, or you could go to the profit and loss chart. You can manually do adjustments. As you did before, may think about rolling this up now. I could sell the 35 for a loss, but buy the 40. This might put me in a better position. I'm just going to take midpoint price. I'm going to use income method number 4 to roll it up. I would have wanted that to take out half the risk. I'd like to see this down to 7.6 or 7.7. It didn't quite do that. Okay, but I sell, not going to like that. That's too little premium. If I do an income method number 1 on top of that, hey, if the stock's right at 40, you could be at a 2.7% gain, and you've reduced the risk to only 7.5%. Common 4 and 1. Could you do better going shorter term? Perhaps. You know, you rolled the put down and out in time, but you may be able to sell this 35 put now and then buy back into September the 40 put. Nah, that's not going to work. You're not going to like how this looks. You're shortening the time, and I messed that up. You're just going to sell. Nope, I just need to sell one. There we go. So this gets you to that 7.2% risk with the September series now, rolling in time, only paying about $1.80 back into the position to gain 5 points of guaranteed payout. You could knock this down by 60 cents by selling the 40 call, maybe an income method number 6. Okay, but yes, remember, we entered the married put because none of your puts had expired, so we entered it as you did it for day 1. We just went to position actions and roll leg. Now we see where we stand correctly with the January 35. We went to position actions and position analysis, but it didn't give us any rollout opportunities based on the rules in the blueprint. So I can either go to profit and loss chart here or click on what if calculations from the analysis page and run some manual potential adjustments here in the portfolio. Okay. And so that position looks very similar to an email I had earlier this week. And I replied to that email. It was a BYD position with very similar numbers and another position, which I forget which one it was. I updated both positions in your portfolio and sent you an email that walked through how I did it. So if you didn't get that email, let me know. But if you log on to your account and look at your portfolio, both of those positions should be there. I'm almost positive that we're talking about the same thing. Okay. All right. So Sam asked a question. It's a question thought. Okay. Yeah. Sam has first, I'm sorry, Sam, these were out of order. So let me go this way. Sam first has a market comment. So I'm not going to say I agree or disagree with, but his thoughts on the market. He says, this week is not for covered calls. What hurt you in the money strategy was bull put worthless. Market was very powerful on the upside this week. So yeah, he's concerned that the upside movement was strong. Covered calls might not be the best idea. And Sam, you might have sent that in a while ago. We were talking about that AMAC covered call position that Rajiv just followed up with as well. And again, remember what we talked about here is that when analyzing a roll, it's okay to roll for a debit, but the new return has to match your target goals for what you'd be doing for a weekly or monthly series. Okay, and Sam says, how many stocks or options positions at a time this year? You're only trading 3 or 4 stocks or options. We'll add a, I'm sorry, 3 or 4 stocks or options. We'll add a new stock if I sell the old one to keep my stock count to 3 or 4 at the time. Okay, he's just trading mainly Apple, Netflix, that WVE one you mentioned today, so forth and so forth. You sold out of Twitter and Snap and Riot, and you've got no UVXY. Okay. What I've typically not cut down to, but I'll show you exactly here. I'm going to open one more trade. Is this it? Yeah, I'm going to open one more trade in the next 2 weeks, but these are my positions in RAT. It's actually about $3,800. This isn't my whole portfolio. This is what I'm allocating to radioactive trading. I'm in AMAT, which has been all over the place. All right, I'll admit it, honestly. I'm going to go to charts and go to big charts. I haven't made an adjustment on this since around December. And I missed a ton of opportunity. When it fell down to 50 or 51, I got scared. And then when it came back up here, I was actually going to close the position here. When it came back up, I was really excited, and I did not play it right. I should have done that synthetic straddle we were looking at around here or here, especially here when I saw the signal and it crossed over. That was my mistake. Or should have done bear call spreads, income method number 6, all the way down the line. But I didn't want to get trapped. And it's just the last 4 days, as Sam mentioned, that strength. After that correction, 9th, 10th, 11th, 12th, and 13th, we've gone back from 49 up to 56, a 7-point movement on a $50 stock. Very impressive. And I'm holding the 60 put here. So I'm probably going to make an adjustment Monday or Tuesday. I'm going to wait to see what Monday morning does, and then I'm probably going to adjust AMAT. But man, just to think of playing an income method number 12 with a synthetic straddle here as it came back up, closing this out, but then rolling the put back up, and then here probably the straddle again, and then doing bear calls all the way down. Then I probably would have got handcuffed here and had to adjust the bear call and adjust the income method number 12 position, the straddle, to go back to a straight bullish play. But sometimes now that this is crossed over, as Sam mentioned, you follow the trend. Here's the new trend, the MACD confirmed crossover back above the 20-day moving average. Wait to see what happens Monday morning, but I'm probably doing an income method number 5, the ratio call spread on that. Anyway, Sam, I have 3 married puts open tomorrow. For some reason, my cash base is off by about $1,100. It's closer to $4,000, $3,900. I'm probably going to open another married put next week or the following week. But again, as you've always heard me say, this is about 40 to 50% of my total portfolio value. I'm allocating, we saw it last week, I'm allocating 10 to 15% of my remaining portfolio to 2 to 3 bull put credit spreads per week. Remember, I got hurt on the ones last week, but I had that $8,000 profit or so on the VIX calls that I bought on the 29th, which countered the loss in the bull puts and gave me that extra $2,000 or $3,000 profit. Okay, I have the 1 calendar spread still open right now that kind of taking a bath on. Where did we save that last week? I might have been in a different account last week. I'm sorry, I'm trying to find it. I know that I showed it in a portfolio view, and I apologize. This is definitely not it. Okay, I'm sorry. I know it's not that one, Sam. I must have been in my personal account when I did the webinar slides for the 3 bull put spreads I was in. I was only in 2 this week. They both worked out well. So following the bull put weekly and the 1 calendar spread. So as of next week, sometime next week, barring any major changes in the market, I'm going to have 4 married puts open, all with expirations out other than applied materials, which I've been in since before November, okay? But these are all to September, July. The next one's probably going to be September or October, depending on when I open it. I'll open 2 or 3 more bull put credit spreads Monday for 14 days, or I'm sorry, Tuesday, my apologies, Tuesday the 20th, for 14 days away. So probably March 4th or March 2nd expiration, I believe it is, the 2-week out bull put spreads. And I've still got that 1 calendar spread going as well. I haven't opened a collar yet. I haven't done collars, standard collars, so I'm just keeping that in sort of the married put group right now. I'm holding cash more, but probably next week if we see the strength in the VIX drop, I'll put more allocation up to 15% into the bull puts, open a couple more calendars, and I'll probably consider doing some more straddles. And I'm thinking about longer term straddles actually now, kind of like what you're doing, but longer term on bigger stocks such as Apple, Netflix, Google, and more for a 2 or 3 month period, and rolling the puts and rolling the calls as the stocks move up and down rather than try to get it right away, okay? Yeah, Rajiv says the ratio spread. Yep, that's what I'm thinking is the ratio spread on AMAT if it continues up with my 60 put. I did see one today that I was interested in with a stock count 55. And it was for March 2nd, 14 days away, and I liked how it's not there anymore. It was the 54 to 56, I think, and it was just enough at midpoint where it was a 30 to 40 cent net credit on that ratio call spread. And so it doesn't look that attractive, but this actually went up to 87 if the stock was trading right at around the higher strike at 56 level. So $87, a little bit above 1%. Now that doesn't sound great, and it's not, but remember, I have a 60 put by itself for loss of 4.3%, where it's kind of at right now. So making that adjustment where if the stock goes up to 56 and stays there in 7 to 14 days, it could be a 1 or 2% return on the entire position, or I could close out that spread part and roll the short call, and I might bulletproof the trade while still holding the 60 put, and the stock's only at 56. So it'll be interesting to see. Monday's the trick, because if it falls again, then I'm going to be in that position where I'm reconsidering the entire thing as well. Oh, and Rajiv says, no, I'm sorry, the ratio spread would be a good option with the FTX. I believe so, especially if you're neutral to bullish. I think it'd be a good move on that. It's at 1873 now. You might look at an 18 to a 19. 18 to the 20 probably won't give you a credit, but the 19 to 20 might work as well, okay? Yeah, as you said, Rajiv follows it up with it looks for the metals, okay? Oh, okay, and Mohammed says, thanks, Mike. I saw your portfolio adjustment. I didn't know where to look for the response. It's new to platform. Yeah, I sent you that email. So now what you do when you log on, go to My Portfolio and click on Portfolios. You had, I don't even know if you had named your portfolio here. You just had the one, if I remember correctly. And it might have even been called Test. I personally don't remember what you had it called. But I updated the BYD position and did your second position that you had emailed me as well with your changes. They're both in there. And then the email, of course, I gave you some ideas in the email I sent you on just what we kind of looked at. Oh, okay, Sam, you're at 20% cash. That's about where I'm at now, 25, I think, right now with the other positions I have. Oh, technically right now I'm almost at about, oh, geez, 35% cash because my bull puts expired and I haven't opened new ones. I wait till Monday to open them. I don't leave them open over the weekend. And then the cash that I have remaining here. So my bull puts have been cleared out. The 15% cash I'm still holding on right now, plus the bull put amount, plus this extra, close to $4,000 in this part of the account, which I'll buy a new married put on. So I'm closer to 35, 40% in cash right now, but that'll change on Monday. Okay. Rajiv says he had good profit in Cisco and TWLO. Yeah, TWLO is one that came in my radar and I missed that one. It looked like it was a good trade. It might still be a good trade as a matter of fact. Oh, you missed. Oh, that's why we didn't see you last week, Rajiv. I hope you got to watch the at least the short portion of the archive presentation. We did a special 30-minute opening, 35-minute opening in last week's webinar and current market conditions and what to do now. And we put that up on YouTube. I'm sure you saw the email. Hopefully you saw that first 35-minute part. It's just a little bit of intro and fun. But Rajiv wasn't with us last week. He's been in India for the past 15 days. He missed all the fun. And they traded Cisco, Twilio, and FCX. And some of the others he's been managing past 60 days back. Okay, so you missed all the VIX fun and everything. It was a fun time, Rajiv. It's good to see you back, and I hope you had a good time in India, whether it was for business or whether it was for personal, or hopefully it wasn't anything else like that, anything negative. I'm sorry why you had to travel to India. But good. You're back now and got some of those trades on. And yeah, and the Riot trade that Sam had also was kind of fun. Yeah, you got. Oh, sorry, that's what you're saying, Sam. You got Riot instead of Cisco because you didn't get into the price or didn't get a good price after earnings on Cisco, so you ended up in Riot, which worked out, amazingly for you. All right, well, ladies and gentlemen, we are at 6 o'clock Eastern Time. I don't see any other questions any other questions that have come in. I've cleared out the entire questions as I've gone through them and the comments. If I did happen to miss a question or we want to review a question there, go ahead and send that to me now, and we can cover that. In the meantime, we'll just go ahead to the remaining part of our slides here and sort of wrap up. Just a brief reminder, everyone, of course, as always, is that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. That being said, yes, I did open that Interactive Brokers Married Put today, posted it on the Fusion portfolio, so I'm assuming some of our Fusion subscribers followed me into that trade. That's what's available at radioactivetrading.com, the Fusion subscription. So you saw what I did today. You can try to do that on Monday. Your prices will be different. Remember, options involve risk. We've all seen that. It may not be suitable for all investors. I don't want to, I'm not going to bring up the name, of course, but Ernie had a conversation with a gentleman today who had to cancel PowerOptions, and he's been with the PowerOptions and radioactive trading for about 2.5, 3 months, I think, as a subscriber. And he wanted to cancel both because he lost money. And Ernie said, well, I know we've taken a hit recently, but how did you lose money? Well, he'd been following all the webinars for radioactive trading, watched a lot on YouTube. I believe he even purchased a few videos, but he still thought that the puts were too expensive to bother with. So through the end of December, middle of December, end of December into January, he thought he was following the concepts of married puts and protective position and proper position sizing, but all he was doing was buying calls. And he was buying 20 contracts of calls here, 15 calls here, seeing if Ernie made a trade that was a married put, he would just buy 15 to 20 calls instead of doing proper position sizing when Ernie was doing 200 shares and 2 puts, blah, blah, blah. So he calls up and he says, I'm losing money. And Ernie says, well, how did you lose money? He says, well, I was buying the calls because the puts were too expensive. Yeah, so during the flub, and it's not to say he won't recover from those positions that he's in, but during the flub last week, all of his calls were down 70 to 80% because of the decline. He bought short term. He bought out of the money. He overinvested. And he thought the puts were too expensive. Had he only opened 3 or 4 married puts, he'd be only down 4% of his portfolio right now. He's down about 65% of what he invested at the beginning of the year because he just bought calls and did a couple bull put spreads, didn't pay attention, and overtraded. So, yeah. that ended up happening, okay? James says, here's a comment, and this is an interesting comment, but I just wanted to mention that they involve risk and not for everyone, but it kind of amazed me. He said the puts were too expensive and he would get better returns with the calls, and now he's at a 65% loss in his portfolio. He would only be at a 4% loss. And of course, reminder, the markets are closed on Monday. And real quick, remember you can go to PowerOptions. You can take the trial that we saw today, put in your first name, last name, and email address, and you'll have all of the information there as well. To take a 14-day free trial, no credit card needed. PowerOp.com, name and email, and then click Start My Trial. And going backwards from what Daryl asked earlier, we have an end-of-day service, which is $40 per month, the 20-minute delayed, which is $60 per month. Now, the back testing tools are only available as an upgrade. It's $100 per month to get the delayed service and access to the back testing, the historical option chain, and the other historical tools, which go back to April of 2006. And then the real-time service by itself, so anytime you run a search or look at your portfolio, it has the real-time data, but then the full service gives you real-time plus the historical as well. So it's an upgrade. So at $100 or $160 per month is the full access to the historical tools. Of course, so we've got our other free stuff there, blog.powerop.com. We referenced the archived webinars a few times today, powerop.com/webinars.asp. You can also go to the YouTube channel to look at those as well. Okay, James, he says, why are there only 4 or 5 people that you talked to on the Friday seminar? There has to be more people watching. Last week's webinar was 62 people attended. Today's was 47 at the peak, with some coming in and out. Sam is sort of a good teacher and presents good ideas and good thoughts on market direction during the presentations. Rajiv, of course, missed a week. Arvind usually asks a couple questions when he comes in also. Daryl had come in with his questions about the tools and so forth. So I think we had, and of course there's several more questions that have come in, the Muhammad questions that came in and a few others. In general, James, what I find is that on average on these Friday sessions, we're at 40 to 45 people, I think, that are attending live, varying times, okay? So at the peak, it's probably 45 and it fluctuates. Usually it doesn't go below 20 or 25 until we're at the end. You know, people start logging off, or we pass a little bit past 5:30. Yeah, but in general, it's probably 20 to 25% of those attending ask questions. And that's just the way it is. Some are here just to learn and listen. I know that I have a gentleman who hasn't asked me a question in 6 months who has been to pretty much every Friday presentation and watched the archive when I posted at least twice. He hasn't posed a question in a few months. It's about 3 months. I'm sorry, I haven't seen a question for 3 months, but I know he's been to every one. He's attended live, 95% of them in that 3-month period. He's attended live and he's watched the archives twice. So, you know, some people just like to listen, James, and there's nothing wrong with that. Some people need to have a question asked. I'll see a new name I've never heard before that asks a management question, and there's nothing wrong with that. But in general, we've got 40 to 45 people at the peak live. I'd say the average throughout the whole presentation that are watching this webinar is 35 to 38 people, and then as we've seen in the last 10 minutes is tapered off. There's 27 people, it seems, in the room right now still listening and still watching with us. Okay. All right. So some like to ask questions, some don't. You've seen me before too. Some will send in their questions ahead of time. Daryl tried to do that. I just missed it, or I didn't get the email before the webinar started. A lot of times the first two questions we handle are from emails that get sent in sometime between 3:30 and 4 o'clock Eastern time. And I'll take those off the bat, and then there's no follow-up questions, although the attendee is still there in the presentation. Okay? All right. Sam, you had mentioned that, of course, the weather in Connecticut is getting cloudy and you're getting ready, cold, expecting the snow tomorrow night. Yeah, we're going to get much less than you, but we're going to get an inch or two Saturday night, and then into Sunday morning it should go up to 3 to 5. We just had rain today, but it's starting to get colder. It was about 60 today here in Delaware. Now it's getting a little colder, but yeah, we're going to get that snow too, just not nearly as much as you. All right. Well, ladies and gentlemen, thank you very much for another exhilarating Friday open forum Q&A session. Markets closed on Monday. Take a relaxing break there. We'll see. We'll be back at it on Tuesday, of course, seeing where things roll. And as I mentioned, I'm going to see what happens on Tuesday with the AMAT position. Might do that ratio call spread. And see if there's another position to enter. And if the market's looking good on Tuesday, I may or may not. I likely will. I likely will open some bull put credit spreads following that bull put credit spread weekly strategy I do. So I'll probably open 2 or 3 positions then. And then we'll be back next Friday. And we'll have other webinars next week also, so you'll be able to register for those at PowerOp.com or at Radioactive Trading. All right, take care, everyone. Have a fantastic weekend. Have a fantastic extended weekend. We'll see you soon. Good night.